Hey everybody, Jeff Gibby here. I hope you're having a good day, good Wednesday afternoon. I'd like to welcome you. Thanks for coming today. We have a great speaker who says that he hasn't had a losing trading day in 3 years. So I'm very interested to see what he says. But let's go ahead and get straight to the legal disclaimer. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So, with that being said, I want to introduce you to I want you to give a warm welcome to Asubio Nani. He's going to be doing a bit of a demonstration for us. He's been working with us for a little bit. We're doing some development work with him. I'm really curious to see what he's got to say to us today. So let's go ahead and bring him on here. Asubio, how are you?
Fine, fine. Thank you. And what about you?
Aside from a slightly lingering fear that I might be pronouncing your name incorrectly, I'm doing great.
Yeah, indeed.
All right. So why don't you? We're gonna go ahead and get you started. Why don't you tell us a little bit about yourself?
Okay. Perhaps I may switch to my screen and to show my slide because I have some information to show from my slides, in
Yeah,
fact.
absolutely. We've got.
Okay. Just a moment. I'm switching to my screen here. And tell me when you will see it.
Okay, I'll tell you when it's ready. So we do see it, and it should be full frame for everybody, including our YouTube audience as well.
Okay. And so what is the content of my presentation today? I will quickly make a quick background on myself, who I am, just to let you know what I'm doing. And then I will give a very, very quick definition of what the max trading system is. And in that context, how we define our entry setups and essentially how we define our exit setups. And I will show some example of typical exit setups we have, because these exit setups are closely linked to the way to handle the risk when we are in a trade, when a trade is opened. So who am I? In fact, you have perhaps realized through my accent that English is not my main language. In fact, I am a Belgian trader. So Belgian, and living in France for more than 20 years. And so in France, people are well known to not speak English in a very excellent way. And so I am, in fact, a former software engineer. I have been an IT manager for around 28 years. And during the last 15 years of my profession in this activity, I have had the privilege to work for big banks in Europe, in France, in Germany, in Luxembourg, in Belgium, a bit in Switzerland, in UK too. And this has given me the opportunity to be in contact with some traders in their dealing room. But I have an experience of around 35 years in investing and trading in several types of market. Not all the market, but many of them: the stock market, the options market, the futures market, and since 2000, exclusively the forex market. And until 2008, sorry, I have been a part-time trader, but since 2008, I'm a full-time forex trader. So I have had as a mentor Dr. Jim Pruitt, known as Tiger by his student, since until 2009. He was the inventor of the trading system I'm going to talk about today, the max trading system. And when I took his courses, I have found this system so amazing that I have developed a passion for this system, and he very soon asked me to assist him in grading the homeworks he was assigning to his student. And when he passed away in 2009, his partners, Craig and Chris, have asked me to become the new Max teacher, in fact, and it has been a great honor for me to accept that challenge while trading myself with the Max. So this is who I am. If you have any questions, feel free to post them in the questions area of GoToWebinar. I'm going to explain some very basics of what the max is. I will not describe the max in detail. This is not the purpose of today. But what I would like to emphasize today is how we consider the risk while we are handling a position, because this way we'll answer a very important question: how we can define our exits. For many traders, indeed, opening a trade is the simplest aspect of trading. Closing the trade seems to be the most difficult aspect. And it's true that trading is never easy. Trading is complex. And so we have a lot of challenges to overcome. I will not explain the problems of fear of missing a movement, fear of having a losing trade or a streak of losing trade, and so on. Many traders also try to predict the market. And in fact, with the max, as I will explain, we do not try to predict the market. But we consider the risk when the risk appear, when this risk becomes too much important in order to force us to take an action, to take a decision and an action in order to control, to reduce, and possibly to cancel that risk. So this is what I'm going to explain today with some typical example of what we are doing. But before that, I need to define how we consider what must be a trading system or a trading method. It makes sense for me that when we want to define a trading method, we have to define what are the movements we want to trade. And so consequently, what are the trends we want to trade, knowing that a trend can be made of several movements. A trend can temporarily exhaust before resuming. And so we define within the max what are the movements we want to trade. And of course, once we have an idea of the movement we want to trade, whatever the reason why such movement unfold, we have to define how such movements and when such movement will start. And we'll define the start of a new movement through a set of potential entry patterns. These entry patterns will be called technical entry setups. Then, when we have an entry setup, we do not still have a trade. In order to have a trade opportunity, we will have to validate that entry setup under several types of conditions. A very important condition will be the technical aspect, of course, because the technical aspects define our entry patterns. We have also to consider, and this is an even more important aspect of the trade, the risk we associate with the trade. And then an even more important aspect is the validation with the global context. We never take a trade against the context, or we can sometimes take a trade against the context when we understand the structure of the movement under that global context. I will define a bit later what we consider what we call the global context. And we may have other conditions to define an entry setup. And when all these conditions are fulfilled, then we have a trade and we open the corresponding position. So now along the position, along the trend, along the movement, we will have to define also how to handle that trade. To handle the trade, this means how can we add progressively to the trade in order to build over time a bigger position in order to extract more profit from that movement while controlling the risk we have on that position. And the main priority of a max trader will be, in fact, to control that risk in order to reduce that risk progressively in a very progressive way until we are able to completely remove the risk from the trade. At that moment, when the trade becomes a risk-free trade, we can then focus on how to optimize the profit we extract from the trade. And of course, at some point, we will have to define how we can perceive the exhaustion of the trend or of the movement we are trading. We are never sure at 100% when a trend will exhaust, but we can have some guidelines when the trend or the movement is exhausting. Now, when I say the trend is exhausting or the movement is exhausting, this does certainly not mean that the trend is reversing. Reversing and exhausting are two completely different behavior, but the exhaustion of a movement may be a good place to close the trade in a total way. So this is how, in fact, in our methodology, we define what a trading system should be and how we define, in particular, the max. And so consequently, the entry setup, as you have realized, represent a high probability opportunity based on the three types of conditions I have mentioned. But we have a similar approach with our exit setups. I have said that we never try to predict what the price must do, should do, could do, but we prefer to consider what is the risk which may appear while a movement is unfolding and while the trade follow the price, of course. And what we call a risk will be a situation when we will have to decide to reduce that risk we have on the trade. I remember many years ago, a very known trader, unfortunately, I don't remember the name of this trader, has defined a trend as a succession of failed reversal. And so sooner or later, one of these pullbacks will become the reversal. And this has hit, in fact, in my mind to define the risk situation. Let's take the example of a trade in an uptrend. So we have a long trade. Whenever the price is making a pullback, because we never know how that pullback can be deep, how it can go far in the pullback. So this pullback may represent a risk. And the question is, can we quantify that risk? Or when is this risk considered as too much important in order to force us to take an action in order to reduce that risk? And reducing a risk on a trade can take two forms. The first form will be to close partially the trade in order to bank some profit. And a second possibility will be to also close a portion of the trade in order to reduce the loss we may have on a potential losing trade. So the risk may be on both sides, a potential profit and a potential loss. And all our exit setups, in fact, we have many exit setups with the max trading system, are made of several categories. We have exit setups based on technical indicators. We use several technical indicators within the max, but we don't trade the indicators. We use the indicators as tools to help us understanding faster what is happening in the price movement. We use also pure price action behavior to define when we may have potential exit. We have also some combination of price action and indicator. We have also timing aspect. If you have experience in day trading, because this is especially true in day trading, you know that some hours or some time along the day will be extremely special, and very often we will see with these hours some price reversal. It is very easy to observe, for example, that during the London Open, during the US Open, during the Wall Street Open, we may have some reaction to in the opposite direction of the underlying movement. So another very important aspect of the timing consideration is the news releases. Whenever we have an important news release, we know in advance through the economical calendar, we have to take that aspect into account in order to avoid to be trapped in a very volatile moment and possibly in the opposite direction of the trade. And then we have another concept which helps us to perceive the possibility of an exhaustion of the movement we are trading, and we call the movement invalidation technique. And then we have, of course, the trend reversal. In some circumstances, we can see that the trend is clearly reversing. And so we have a lot of different types of exit setups in order to be as accurate as possible to make our exit. Sometimes we make our exit on the pips with 1 pips of accuracy compared to the high or the low the price is doing, depending if we are trading long or if we are trading short. And so we have many of these exit techniques. With the max, we have approximately 20 exit rules in all these categories. And again, these exit setups are not tools to predict what the price can do when a pullback is happening. We do not try to predict where the price can go during this pullback, but just to quantify when the risk during a pullback becomes important enough to force us to take, in fact, a decision to reduce that risk. And I will illustrate that with an example in a moment. So here I have on this slide, but I will show directly on the platform. I like to illustrate all my example on platform. This pair is the pound Aussie. What I'm explaining is valid for any pair in the Forex. We trade the main pairs. We have the main 8 currencies: the US dollar, the euro, the yen, the pound, the CAD, the Swiss, the Aussie, and the Kiwi. And so this defines 28 pairs, but not all the 28 pairs are nicely tradable, because in fact, the max is a trend following system, and some of these pairs do not nicely trend. A pair like the pound Aussie, the pound Kiwi, the pound yen, the euro US dollar, and so on, have nice trend regularly, day after day after day. And this is an example of a trade. I'm not showing the entire max trading system here, but some very important aspect. So here at this point, what we call a short ETF BMO represent one of our entry setup, and it corresponds to an entry setup to go short, to take a short trade. And along the trade, in fact, whenever you see on the chart a green vertical line noted as C1, as C2, these actions represent scalings. So we add to the initial position in order to progressively increase the size of the trade. These scalings are made in such a way to still control the risk on the entire position. And so an important role in the trade risk management is also the role of the stop loss. We always associate an initial stop loss, and we call these stop loss ESLs, emergency stop loss. The aim of our emergency stop loss is not to protect necessarily the trade, but to protect the trading account. There are sometimes circumstances when we have a technical problem, for example, a problem with our internet connection. And so we become blind for the trade. And this stop loss, in fact, is the protection tool for our trading account. And it is on this initial stop loss, so emergency stop loss, that we associate the risk to the trade. It may be, for example, a 1% of the trading account. It may be 2% of the trading account. In fact, any risk level the trader feel comfortable with. This is an important point. The trader must feel comfortable with the risk taken in the trade. And so we calculate the size through our position sizing concept, the size of the trade, in order to fulfill that trade risk management. So the position sizing takes into account the risk in percentage of the trading account and the size of the stop loss. And along the trade, we have specific rules to adjust the stop loss. So in order to reduce the risk we have on the trade, we have specific rules, precise rules to adjust our stop loss. This is important, especially when we make scalings. Whenever we make scalings, so we have additional position having the same size as our initial size. Now comes the exits. We make a lot of partial exit. These exits are called MX. An MX1, for example, and MX is an acronym representing momentum exit. And in fact, I'm illustrating here several types of situations. Let's consider the first potential MX on this red candle with this magenta vertical line. This is an exit setup which is based on one indicator, one of our indicators. This is a typical indicator we use. This is the stochastic. In fact, in reality, we use the stochastic of the RSI indicator, the STO RSI as we call it within the max. And with this kind of momentum indicator, we have lots of potential exit setup. Here I'm illustrating two of them. Whenever in a downtrend, the price is making what we call a big actionable bottom, or a big actionable low. We have precise definition of what a big actionable low is. We have an exit setup. And once an exit setup has been identified, we have to identify also where to make the exit itself. If the price follows through and reaches that level, we make a partial exit. And so, in fact, we use these patterns in that type of indicator to define when the pullback is becoming too much important. Because here the price was initiating a first pullback. So we identify the exit setup, and then we identify an exit level. If the price does not reach that level, we make no exit. We keep our trade completely unchanged. This is why I have noted here on the chart no MX. Later on, we have another exit setup with the second blue bar, which corresponds also to another type of pattern this kind of indicator is giving, which is the well-known divergence. We have here a bullish divergence. The price is making lower lows, but the indicator is making higher lows. And so we have a basic regular bullish divergence. We have lots of divergences. I can consider the basic divergence, the persistent divergence, the external divergence, the group divergence, and so on. And so, again, once we have identified an exit setup, we define where to make the exit if the price follows through. And on the next candle, we can say the price indeed follow through, hit our level, and at display, we make an exit. Now, whenever we make an exit, we do not close an entire trade. Whenever, in fact, we open a trade or whenever we make a skidding, each entry is considered as being made of 2 units. For example, if the trade size is, let's say, 10 lots, we consider that 1 unit is 5 lots. So we make, in fact, our exit based on a 2-unit approach. And so here we close 1 unit. 1 unit, which one? We close the oldest open unit. So we will close 1 unit of our initial entry setup, and we keep all the other units as open unit, as running unit. Later on, we can see here we have another opportunity to make a skidding. Of course, we have strict rule in terms of trade risk management to make our skidding in order not to increase the risk on the entire position. But you can see that whenever we add 2 units and we close 1 unit, we will have a long time an increasing progression, an increasing position, sorry. Later on this blue candle here, we have again another big actionable low in our store RSI indicator. We have so an exit setup bar, we define an exit level, and the price does not follow through. So in fact, this means that the risk we had with the beginning of the pullback was not serious enough to consider any action. In the first case, in the case of the MX1, because the price was following through, this means that the risk was increasing, and because we never know how deep the pullback can be here, we have to take an action to reduce the risk we have on the entire position. And most of the time, we will have an MX banking some profit. Not always, of course, because we will have losing trades. You can see another example here, a same type of exit setup with a low, a big actionable low in our store RSI indicator. And again, the price does not follow through enough, not representing an important risk. So there is no necessity here to close 1 unit. We had no other opportunity to make skiddings because the timing consideration was telling us, okay, we are approaching the moment when this movement or this trend will exhaust. We have some rules which tell us also in some typical situations, we can say with a high level of probability when a movement may possibly exhaust. And in fact, here, in reality, we had an indication that the trend was reversing. I'm not showing all our indicators, but we have a trend indicator which take into consideration higher time frame behavior. And so this blue bar where we have this last magenta vertical line was representing a long entry setup. And we apply the same technique as the previous short entry setup. We define an entry level to go long, but this entry level will not necessarily correspond to a new long trade. It will, first of all, correspond to a decision we have to take to close the remaining opened unit on this short trade. So we had made an initial entry two scale-ins, so we have 6 open units. We have made one MX, we have closed one unit, so we are left with 5 open units. When we make our x66, x66 is our acronym to represent a final exit, we close all our 5 open units. And so this is an example with indicator. We have momentum indicator, we have also volatility indicator, which help us to pinpoint when we will have a potential risk, mainly when the price is making some pullbacks, to possibly take the decision to reduce the position of our trade. Of course, in the trade risk management approach, we have also the rules to adjust our stop loss along the trade. Just to give an idea of this trade, the movement was, I don't remember exactly what was the length of the movement, so the price was approximately at 179.40. And when we made the execute, it was 178.55, so approximately 85 pips long, so a movement of 85 pips. And with these two scale-ins and scale-outs, we have caught, in fact, a total number of pips of 330 pips. Considering that our initial stop loss was 15 pips, this represents a realized rework to risk ratio of plus 11 R. I'm using here the Van Taart notation. R represent the risk we take on the trade. If we take, for example, a risk of 1%, this trade has produced a profit of 11% on the trading account. If we take a risk of 2%, this trade represents a profit of 22% on the trading account. So this is how, this is what the R notation of Van Taart means, in fact. So we never fix in advance a predefined risk-reward ratio. We don't fix, for example, a 1-to-1, a 2-to-1, a 3-to-1. We want to catch a portion of the trend or a maximum portion of the trend. If the movement is a short movement, we will have a trade which will look like a scalp trade, and if we have an ample movement, we will have a trend trade. In fact, this was a typical example of a trend trade. So technical indicators are one way to quantify when we have a potential risk, and if this risk is too much important, which is represented by the level we define, so we take the decision to reduce the position we have. But we have, as I have said, also other exit setup, for example, pure price action. And a nice pure price action exit technique is the following. I will take another portion of the chart here. This was another downtrend or down movement, which has been initiated somewhere in this area. I have not indicated the setup we have here because this is not the main point. And here you can see 3 types of bar we call LB. This red candle, this one, and then this one. And so LB means long bar. We have a precise definition of what a long bar is. In fact, a long bar or a bar will be a long bar if its length is twice or more the average length of the bar making the movement preceding the long bar. So in our course, we define in complete details this rule. And so once we have that criteria being fulfilled on a bar, this bar is called as a long bar. Now, the reason why the market is creating a long bar are multiple. And there are essentially 2 types of activity, in fact, 2 types of reason. First reason is a lack of activity, a lack of transaction or trades along the bar when we have just a few trades. So we have a void inside the bar. Voids we can see if we use a smaller time frame. Here I'm using a 5-minute time frame. If you switch to a 1-minute time, you can see possibly, or even smaller, you can see these voids. But another possibility is also a strong momentum, a high activity along this movement. So with the Forex, when we don't have the real volume, we have the tick volume of the broker with whom we execute our order. Even if the tick volume may be a good approximation of the volume, we don't have always a complete detail of the reason why we have long bar. Anyway, whenever we have a long bar, a long bar in favor of the trade, we consider it's always a nice opportunity to bank a profit. And the reason is we don't know if we have a lack of activity or if we have a big momentum. We can have some guidelines to define between these two situations, but very, very often, approximately 2 out of 3 times, a long bar will be followed by a pullback, like this, the example of the last long bar here. This long bar is followed by a pullback. These pullbacks, when they happen, are generally deep pullback. And very often, such a pullback will completely erase the movement or the swing movement containing that long bar. For example, here, it's not the case, but this pullback has completely erased the movement created by this long bar alone. And because of this behavior, 2 out of 3 times is a lot of times. So a long bar is considered as a risk for the trade, but also as a nice opportunity to bank some profit. And so we have to decide an exit level. And this exit level is defined as a portion of the entire length of the long bar. It may be, for example, 20%, 25%, 1/3, 1/2. The size of this portion will depend on the trader's risk averse, in fact. Personally, I like to consider 1/3 of the length of the bar. And so once the bar is closed or while the bar is printing, I define my exit level. And if on the next candle, the price follow through, you can see here that this second red candle has made a wick, which has been deep enough to cross my exit level. And so when the price crosses my exit level, I make an MX. So I close one unit, banking a nice profit, and almost always a profit made on a long bar, and the stop loss adjustment will create a risk-free trade. So the long bar rule, we call it the long bar rule, is an extremely important exit technique we have. Another example is here. One bar later, we have another long bar, which has also created an exit. And then later on, we have another long bar, which has created another exit, possibly a total exit if it was appropriate to make a final position close. So these long bars rules are an example of pure price action exit technique. But we have other price action exit technique, like the 3 reversals bar, the sideways, and so on. So we have, for each category of exit setups, in fact, we have several exit technique. I have also mentioned timing considerations for our exit techniques. You see on this chart, this red dotted vertical line. This was a news release. The pair was the pound Aussie, but this news release was the CPI on the US dollar, the CPI being the consumer price index. So it is a measure of the inflation in USA. And the CPI, in fact, being a measure of the inflation, has over time an impact on the interest rates level. An increasing inflation will force the Fed to increase, or will decide the Fed to increase the interest rates. With an inflation decreasing, this will make the Fed decreasing the interest rates. And so a change in an interest rate may have a deep impact and a fast impact in the market, especially if the interest rate, or if the CPI, which is data which is released, is completely different from the forecast which is made before the release. Because in fact, the market reacts based on the forecast. And so if the deviation between the release data and the forecast is too much important, of course, this deviation must be big enough, and each news release has a threshold level to define a big deviation. So this will create a lot of volatility in the market, and then this can emphasize the trend the price was doing, or can reverse the trend in the opposite direction. In general, an increasing inflation is good for the currency, for the US dollar in this case. A smaller inflation will be bad for the currency, so we should see the currency weakening. But here we have the pound US, the pound Aussie, but even a news release on a big currency may have an impact in all the pairs not containing the US dollar, for example. And this is true for 3 types of currencies: the US dollar, the yen, and the euro. And so You can see here the price was in an uptrend. If we are in a trade at that moment, before the news release, if it is an important news release, because we never know in advance if the deviation will be important or not, we close the trade, whatever the result we have. So facing a news release, 15 minutes to 30 minutes before an important news release, we close all our opened position. Why 15 to 30 minutes? When there is a big deviation in the news release, or when the market suspect there will be a big deviation, very often 5 to 10 minutes before the news release, you will see some speculative movement. You will see an increase in the volatility and some speculative movement, which may appear in both directions. And so this is not for all the news, but it is for some categories of news. And so we do not want to be trapped in these volatile movement, especially if this volatility creates movement against the underlying trend. So 15 to 30 minutes before the trade, the news release, we close the trade. Another important rule we have is if we have an entry setup which appear for a new trade, but too close to the news release, within the last 1 hour before the news release, we skip the trade. We may have a valid setup, but we don't open the trade because 1 hour, especially with the 5-minute time frame, we have no time enough to see the price unfolding a worthwhile movement. Once the news has been released, if there is no impact, because the news has been released with exactly the level of the forecast, which was the case here, the news was neutral. As soon as we have another valid entry setup, we can trade it. However, if the deviation is big enough to create volatility in the movement, we will wait first of all for the volatility to settle down. It can take a few minutes, it can take a few hours sometimes. And once the volatility has settled down and the market is unfolding its fundamental movement, then we can consider any entry setup in relationship or in agreement with that news release. And so this is how we consider an example of this timing aspect to control how we exit a trade, if we have to take a trade or not, and after the news release, when we can possibly consider a new trade in agreement with the news release or with the context, the general context, if the news has had no change. So now, of course, I have mentioned these are 3 types of examples of the exit technique we use. And you can see that at any moment I have made an assumption, so how far the price can move, simply by recognizing some typical behavior either in the price or in our indicators, or a combination of the price and some other indicators. So we perceive when a risk is appearing in the trade, and when this risk becomes too much important by fixing our exit level. So if the price reaches that exit level, we close the trade. And there are some other situations when a news release when we have to skip a trade because we don't have time enough to see a movement unfolding in a worthwhile way. So now, of course, I have mentioned that we have to take into account the context. And I have said previously that the context is the most important aspect in the MAX methodology. And this is also the most important, the most difficult aspect to understand and to apply. And in order to help our MAX traders, the students who follow our courses, we try to give them a lot of information. So what is the context? In fact, what we do on our website, and I'm going to show you an example of our page of our website, every week we update some segment of our website. A first segment will be geopolitical elements. What are the events around the world we have to take into account and which may possibly influence the markets, not only the Forex, but also the other markets? A typical example nowadays is the Brexit, of course, in UK. But we have also some other situations like in Middle East, in Far East. We have some situation in Europe, for example, with the situation in Germany, especially the financial situation, but also in Italy, for example, and so on and so on. we have also a modified economical calendar in which we keep only the news releases which have a tendency to move the market, because not all the news releases move the market. There are news releases which are commented a lot on some medias like a TV channel, like newspaper and so on, with a lot of people talking about that. But even in the case of a big surprise, they do not move the market. And so in our adjusted calendar, we keep only the news which has the potential to move the market. And we mention them, we mark them as major news. And so, for example, here, um, last Tuesday, so it was yesterday, if I'm right. Yes, it was yesterday. We had during the ASEAN session the cash rate and the rate statement for the Aussie by the Reserve Bank of Australia. We mention that kind of news as a major news, H4 plus. What does it mean? This means that an important news release with a big surprise will have an impact in all the small time frames. And the small time frames are from the 1 minute time frame up to the 1 hour time frame. When it is indicated as H4 plus, this means that in case of a big surprise, the impact will be also present in the higher time frames, the H4, H8, daily, weekly, um, and so on. And we have also we keep an eye on some minor news release. We indicate as minor. These type of news do not create big impact in the market during the day when the news is released. They may have an impact later, but when we day trade, we don't see a lot of impact, but they can create some additional volatility. And so we mentioned them also on our economical calendar as a monitor news. So that type of calendar is followed after that here with what we call the top 10 list, which is updated also every weekend, and which represent the most moving pairs over the last 4 weeks. And usually we have a list of maximum 14 pairs, which represent half of the 28 main pairs, but sometimes it contains less pairs. And then when we match this top 10 list pairs with the calendar, the economical calendar, we can deduce, in fact, for each day of the week, what are the main pairs we have to consider. In fact, for example, today, Wednesday, so the pairs to consider as having the best probability to make nice movement, nice trend, were the pound Kiwi, the pound Aussie, the pound CAD, the euro Aussie, and possibly the euro Kiwi. If I show you what the pound Aussie has made today, for example, we will have, this is precisely the pair I have used for illustrate the concept I wanted to show you. This was the trend of today. You see a nice uptrend of the pound Aussie from a price of 178.35 to 180.25, so 200 pips up movement. So of course, this was not a unique trend. There were two major trends we could have traded with the max. The first trend here, this first portion of the trend, and then some pause in the market, and then the resumption of the uptrend with this second movement. So this is how we try to help our members to define, in fact, the context through this kind of information. And you can access this page freely. So it is a free resources we offer to everybody. So you can use that page to, if you want. So you can explore it and you can see if it is worthwhile in your trading. So these slides show on my PDF the example I have just to show you. So in fact, this is how we consider the week. So our exit setup have the aim, in fact, to define when a pullback appears, and this pullback create the risk on the trade, because this pullback will decrease the potential profit we can make on the trade, or can increase the potential loss we make on the trade. And so we have to decide what is acceptable as a decrease in the profit or as an increase in the loss. And so this is the objective of our exit, which is great because we don't need that way to define or to try to predict what the price should do. in fact. I have explained in order to help our members how to better identify the pairs which have the potential to define everyday trends. So this is exactly what I have explained. We also offer to our members some other what we call freebies, for example, price levels. We define levels of potential supply and demand where the price can react. If you want to have information about that aspect, so you can contact us. I have put here the contact details, our general website, our email address, and even we can also be contacted by Skype. So if you want any information about the Max. So this is my presentation. So I thank you very much for your attention during these 3/4 of an hour presenting some important aspect of the Max. If you have any questions, so feel free. Craig and myself will have the pleasure to answer a maximum of your questions. So. Any question about all I have presented here today? And we will be soon able, in fact, to present our entire methodology. I don't know exactly when, but this is something which will be possible in a near future. So in such a way, you may have a better idea what the Max methodology is, and if this can fit your objective in trading. So, but the Max essentially is so a trend following system, and we will add very soon a scalping approach, a more detailed scalping approach when the price, for example, is ranging like we are seeing in this portion of the chart. We may have sometimes some nice scalp trades. So any questions about this presentation? We are always glad to answer all the questions. And I observe that I have respected our time limit. It's always a challenge to limit our presentation to just 1 hour, so
Yeah,
or a little less.
I think you did a good job today, Asubia.
Oh, thanks.
I did want to kind of just mention things. We are looking at kind of doing a lot of the programming and coding and setup for the Max trading system, and that's something that we hope to do here in the fall. But I don't see any questions coming either through YouTube or through the GoToWebinar. But I think you did a great job. I guess one thing you could kind of go back to is the slide, so people can kind of write down the contact information to get a hold of you if they need to.
Yes, sure, absolutely. Here.
All right, so that's maxtradingsystem.com/newswatch. Go ahead and sign up for that. Asubio, any final thoughts for the webinar today?
A final thought, yeah, perhaps trading is never easy. In fact, when we want to become successful in trading, and trading is never or must never be considered as a business, as a hobby. It must be considered as a business. What I mean by a business is we need to stay committed and focus on what we are doing with a structured trading plan. We need to know how to organize our trading session. So and this is what we teach in our courses, how to organize our trading session with some daily preparation routines, how to analyze the news release, how to consider the global context, what are the geopolitical elements which may happen and influence the market, keeping ourselves informed along the day with what may happen around the world, which may have also an impact in the market. A typical example is what is happening almost day after day during sometimes several times a day with the Brexit. So, and then follow with patience and discipline the concept and the rules of the trading system. It is not a requirement to become consistently profitable. But to become consistently profitable, we need, first of all, to become consistent in the way to apply the process, the trading process. It's the consistent application of the trading process which generate the consistency in the profit. And in that aspect, in fact, the first priority of a max trader, this is what we try to make them understand is always the risk we have on each trade. The risk must always be wise. The risk level is up to each trader because each trader or all the traders do not necessarily have the same risk aversion. So personally, I don't like to use a risk more than 1% on my trade. Usually 0.5%, maximum 1%. So, and following with patience and disciplines all the rules of the approach in all the aspects, the technical aspect, the risk aspect, the global context aspect. The aim is not to try to catch every movement the market is making, creating, but to take only those who gives us the best odds to have winning trade. And with the global context, we have the edge. If we understand the event impacting the market when they happen, then we have logical trades we can exploit. And this requires patience, in fact. In trading, especially in Forex, we are paid most of the time waiting for the appropriate conditions. And this requires dedication, in fact.
Line me up. Okay. All right. Thanks, Asubio. Appreciate your time today. Good job. Look forward to working
My
with
pleasure.
you as we get going into the future. And for everybody that came today, appreciate your time. Thanks for coming. And as always, we'll see you at the next one.